Welcome to the Purpose-Based Retirement with Certified Financial Planner Practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Good to see you again. Thanks for joining us. I am Lee Kelso here with Casey Weade and Marshall Johnson, certified financial planners with Howard Bailey Financial. We have a special guest joining the program today. He manages over $6 billion in assets. So if, like me, you're close to retirement or maybe already in retirement, I know you're going to want to stay tuned to hear what he thinks we need to be paying attention to. And then we're also taking our viewer questions today. We have a caller who's not really sure why, he just knows he hates annuities and wants to know what are some alternatives. We'll see what Casey and Marshall have for him. But Casey, I want to get it to you so you can introduce our special guest.
Thank you, Lee. Today we have a very special guest joining us on the Purpose-Based Retirement. That is Mike Sorrentino. Mike Sorrentino is a Chief Investment Officer of Global Financial Private Capital, overseeing a team that manages over $6 billion in assets across the country. He's also a chartered financial analyst, a very difficult designation to achieve. And essentially, if I were able to summarize it myself, I'd say this is equivalent to a PhD in portfolio management. He's going to be sharing with us what he sees to be some of the major challenges that investors are facing today, and also share with us some opportunities for you to input some of these things into your portfolio so that you can guard yourself against these risks moving forward. Mike, welcome to the show.
Oh, thank you for having me today.
Hey, we're very happy to have one of our partners here with us on the show today. The Global Financial Private Capital and Mike have provided a lot of investment management services to our clients over the years and provided us with a lot of insight and research and background to what's going on in the markets today. And one of the articles that you recently wrote was the 5 biggest challenges facing investors in the world that we live in today. And that first one was what?
We're all living longer. You know, believe me, that's a high-class problem to have, but we're living longer, and with that, that means our nest eggs, they have to live longer as well. And if you think about the difficulty, particularly in the interest rate environment that we've been in the last 8 to 10 years, this is a challenge that will remain going forward for quite some time.
Yeah, I think if we look at this chart, we can see from 1950 till today, individuals back in 1950, a female was living to age 80, now all the way to age 85 on average. And men, age 82 today, it was just 77.8. And I think my family is a great example of that. My wife, she had about 12 different grandmothers when we originally got married. And that was due to longevity in her blood. And I think we have to take that into consideration. She had great-grandmothers, great-great-grandmothers, and a lot of people in her family lived past age 100. And that's just something that's beginning to happen today. People are living longer and longer lives, and so what they want to do is they want to see their money last longer, at least as long as they do, and in many cases they want it to last longer than they are.
Yeah, it creates quite a problem. Retirement used to be a 10 to 15 year period of time. People nearly work to death in fields and factories, and today that's just not the case. So this longevity, making that money last, creates quite a problem.
One of the things that we talk about occasionally on the show is that there's fewer and fewer pensions that are out there today. People are now taking their 401ks, they're rolling them over into IRAs, and they're managing them, right, themselves in many cases, or they're having somebody else manage them in this 60-40 investment portfolio and hoping those dollars last for the rest of their lives. And in some cases, we want to create a pension. We want to give them some guaranteed income to be their floor for the rest of their lives. But even with those other dollars that we have, we still want those to be there for health care in the future, inflation in the future, long-term growth. What are some things that people can do today in order to ensure that those dollars do last as long as they do? What is different today than the way it was 50 years ago? Something you talk about a lot is the 60-40 playbook.
Oh yeah, and you don't have to go back 50 years for this. I mean, you think about the 60-40 playbook. That was really this idea of put 40% in your portfolio in bonds and 60% rather in stocks. And that diversified portfolio would get you through, call it any type of economic environment, which, by the way, worked quite well since the 80s. And it did its job. But if you think about today, and this should be no surprise to, I don't think, anybody on the show today, markets today are so much more complex, and the sophistication required to do what was so easy to do even a decade ago has elevated from here. So this idea of the 60-40 playbook, which worked well, it's like bringing a knife to a gunfight right now. Well, we need something a little bit more sophisticated.
I think we can see what happened, during the 80s and 90s. During that period of time, the longest bull market in history. It was a market that was up over 1,000% in just 17 years. Introduction of 401ks. Now we took money directly out of a paycheck and injected it straight into the stock market. We had the internet. We had easy credit. We had a lot of great things going from the market through the 80s and 90s. And then now what I see with people that are walking into my office over the last 15 to 20 years, these people have been walking in our office saying, we don't want to go through that again. We don't want to go through another time period where we have to go through losing half of our life savings. But if we invest like we did back during 2008, maybe you just have a portfolio of mutual funds, 60% equity funds, 40% fixed income funds, or a stock and bond portfolio, it's not true diversification. So what is true diversification? What types of tools can we use if it's not just stocks and bonds?
Well, if you think about the financial crisis, and this is, I'm sure, resonating with a lot of people out there, is that they thought they were diversified back in '08. So I've got all these stocks, all these different bonds, diversification across these different sectors. They weren't. Because during times of crisis, everything correlates or moves together, and that was the result of everybody going to cash. Now, there was a type of investor back then that actually didn't necessarily do all that bad. If you look at some of the large endowments out there, they did just fine. And the reason why they did just fine is because they had true diversification. They weren't dealing with just stocks and bonds and trying to figure out the right percentage between these two asset classes. They were invested across a broad range of asset classes, 8, 10, maybe even 15 in some instances. And the benefit you get from that is that when everything starts to move with stocks, if you hold assets that don't move with stocks, you get that diversification. You get that smoother ride over the time. You're not going to take that drawdown, that awful ride that everybody took in 2008.
And you're saying that investors can do they can do this today, like these large institutions. You're saying someone with $200,000 or $2 million or $20 million doesn't have to, they can invest just like the Harvard fund or the Yale fund. They can invest like a hedge fund. They can invest like people that have billions of dollars today.
Absolutely. I mean, you go back to 2008, it was a lot more difficult back then. And really the only opportunity you had to survive 2008 was to make a huge tactical bet. If you think things are getting bad, you had to run to cash or bonds or something like that. But today, the tools that these universities were using back then, these endowments were using, are now available to everyday investors.
And these are a lot of the tools that you're bringing to our team, and this is why we've chosen to work with Global Financial Private Capital for these tools that you're able to give to us and let us lend on to just the regular retail investor that has a couple $100,000 or a couple $1 million. So now they have the ability to, rather than walking in with $500,000 and their investment manager says, hey, I can manage that for you, I'll throw it in a few different mutual funds, we'll rebalance a couple times a year. Now we're able to lean on the research of PhDs, CFAs, and a team that's watching those portfolios day to day, which is really important if, number two, we see global economic growth begin to slow.
Remember, slower economic growth is not bad. All right, we're still moving forward, and that's a good thing. But if you think about the U.S., we're the world's largest economy. We're a $20 trillion economy. We can't grow at 5 or 6% every year like we did maybe 15, 20 years ago. It's like Apple. They can't grow at 30% every year unless everybody buys 8 new iPhones this year. It's just not going to work that way. It's a mathematical issue, right? Yeah. If you think about the rest of the world, you're looking at China. They doubled in size in less than 10 years. You go to Vietnam, they have Starbucks on every corner now. Wow. These emerging markets, they've emerged. So we're seeing global economic growth slow, which when you see that type of situation happen, that's less fuel going into the tank for equities going forward, global equities. So if you're putting less fuel in the tank, you have to have an expectation for less output going forward.
Well, population growth is one of those detriments, right? I know my wife and I, we've had 2 children, and after this last one, I think we've decided we want to get our rest back, and we're not going to do it anymore. And this is the same for many people across the country and across the world. We don't have the baby boomer generation anymore. This generation is slowing, and we're seeing more and more retirees out there, and if we're seeing slower economic growth, then that means we might see slower returns in equities over time anyways.
You have to have
which
that
means
expectation.
It's good to throw in other asset classes that can outperform equities and act in an inverse relationship with those equities.
The difference between institutional and retail is huge. And what's happening because of technology, it's now bridging that gap. It's now bringing those two together, and it's very important.
You know, as you would like to learn more about institutional money management, we're going to be back right after this break in order to talk a little bit more about some of the biggest challenges facing retirees and investors today and solutions for you to combat them.
For the next 10 callers who give us a call, the number on your screen, we're going to offer a complimentary review of your entire financial retirement plan. It's that chance to learn about your money so that you can make the very best decision for yourself moving forward that you can. So for the next 10 callers, Casey, Marshall, and the rest of the Howard Bailey team will make time on their calendar to meet with you and give you your very own purpose-based retirement. We're back with questions from callers in just a second.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
We're always concerned about what's on your mind, so let's check in with Brian from South Bend. Brian, go ahead.
I absolutely hate annuities. I can't tell you why I hate annuities, but I do. I'm constantly hearing all the good things about annuities, the guarantees on your money, that type of thing. I would be more concerned about knowing the cons or the negatives of these annuities before I buy into those.
Well, Brian, it is okay to hate annuities. Let me tell you that. It's okay. But the part of the question that bothered me was you said you aren't sure why. And I think that's something we always want to know is the pros and cons. Listen, if it's a stock, it's a mutual fund, we're always going to have some pros and some cons. And I think in this day and age, you listen to Mike Sorrentino in our earlier segment, he's talking about looking at the alternative investments. You just want to know what's out there, and then you can decide whether you like it or not. But Casey, there's a lot of different types of annuities. Some are good, some are bad, but they're not for everybody, right?
Well, there's a lot of different types of mutual funds. There's a lot of different types of stocks, different bonds, different, alternative investments, and not all of those things are good, and not all of them are bad at the same time. I think when we start talking about annuities and you want to know the pros and cons of these things, that's a great question to be asking. First of all, however, I think what you said, guarantees, that really ends up being the downside when it comes with annuities. You can say, well, guarantees are a great thing. However, let's take, for instance, a guaranteed income stream you can't outlive, as in the case you might get with an immediate annuity. Immediate annuity gives you a guaranteed income stream for the rest of your life. You can't outlive it. However, now you've lost complete control over those dollars. I hear a lot of people say, I hate annuities, but they never say, I hate my pension. And that's really what an immediate annuity is. It's giving you a guaranteed income stream for the rest of your life. Now take fixed annuities for that matter. Fixed annuities give you a fixed period of time, let's say 5 years at a 3% fixed rate, but now you can only have the interest out of that account every single year, kind of like you might find with a CD. And you've got penalties. If you take more than that, that's a downside because you receive the guarantee. Think about an indexed annuity for that matter. A fixed indexed annuity might give you a 50% participation rate in the market. Your gains lock in every year. The guaranteed principal has now given you at the same time limited upside potential. And so you have to take the good with the bad, but it's really about understanding what the ultimate purpose is of those dollars. If you're 20, 25, 35 years old, it's probably the worst place that you could ever put any of your investable assets. However, if you're near retirement and you're looking for protection or guaranteed income or an alternative to the bond market or CDs, this might be a good place for a portion of your portfolio. And I emphasize a portion of your portfolio because it's got to be for the right purpose, and make sure you understand all the pros and all the cons before you ever make a decision. And I think it's really good for us to ultimately work with an independent advisor as well. Due to all the different types of annuities that are out there, we want someone that can present to us the best of the best, and that can only be done if we're independent.
Brian, I hope that helps you out. Let's move to Ken from Fort Wayne and your question.
We talked to our advisor and said that we could not afford another 2008. So they reduced the risk in our portfolio, but it just looks like a bunch of mutual funds to me. So we still want to stay invested in the market, but we want to keep our risk down. How do we do that?
Well, there's ways that you can reduce your risk and still stay invested in the market, such as what we've been talking about earlier in the show with Mike Sorrentino. Have a third-party money management firm rather than just having an investor that buys a few different mutual funds and holds on to those things through the good and the bad times. If you have an active manager that's managing that portfolio with a principal preservation mindset, now you know that that individual is going to be watching it day to day, making changes as is necessary. Now, this might mean you underperform the S&P 500, but ultimately that's an okay thing because you don't need to get 10% when the market's up 10% or 30% when the market's up 30%. You just want to make sure that you don't see the lows of the lows. And ultimately it is more important for you to avoid the worst days in the market than it is to get the best days in the market. Another thing you might want to do, rather than adding bond mutual funds to your portfolio where you have to participate in interest rate risk and price risk within the bonds that are inside that fund, it may behoove you to look into purchasing individual bonds for that bond allocation so you avoid a lot of that interest rate risk, that price risk that you get when you own a bond mutual fund. And as Brian talked about earlier, it might be a fixed annuity or fixed indexed annuity that acts as your alternative to your bond allocation, your bond mutual funds, a place where you're going to make 3 to 5%. You have to tie up your money for a period of time, but now you've got bond-like returns without not only the price and interest rate risk, but also the default risk, while your equities can be maintained someplace to still give you upside potential, but now you have something to fall back on.
Well, and it's not about getting into the market or getting out of the market. And I think that's what too often we hear from individual investors. Geez, Casey, is now the time to get out of the market? You just may need to reposition some assets. And I think you gave him some great options. But you go back to Brian's point, Brian may not like annuities. He may not want the guarantees or the limited upside, but this may very well want that. And that may be exactly perfect for him, but it's about solving each individual's challenge.
Time is short, but we're going to jump out to Mark in Wolf Lake for your question. Mark?
I feel like a major pullback is coming in the market, but it seems like there just isn't anything in its way right now. What is it that poses a major risk to the market today?
Well, Mark, that could be anything. You know, I think at any moment in time, there could be something that just comes out of nowhere. Sure, the seas are quiet today, but there could be a number of things that come this way. I mean, our Fed is trying to deleverage. We've got central banks all over the world that have been easing monetary policy, so it could be a big overarching macroeconomic problem. But you know what? Things are calm today, but be prepared for when that storm comes, right?
Well, it's the unprecedented, it's the unpredictable.
Sure.
You know, as we talked with Mike Sorrentino here earlier in the show, who studies the market for 5 hours a day, 7 days a week. This is his full-time job to understand the markets, and he can't predict the next financial crisis. He can't predict the next Great Depression. He can't predict the next tech bubble or 9/11 for that matter. Those are the types of events that can cause huge ripples in the market and present huge risks to your portfolio, but we can guard against these things by having a plan that can succeed regardless of what the market does in the future.
And the first step to developing a plan, I hope for you, will be to pick up the phone and be one of our next 10 callers who calls right now, because we're offering a complimentary review of your complete retirement and financial plan, a chance to get an education about your money so that you can make really good decisions for yourself and your family moving forward. So be one of the next 10 callers. Call the number on your screen. Marshall, Casey, and the Howard Bailey team will make time to sit down, visit with you, and give you your very own purpose-based retirement. Here is our question of the day. It has to do with some of the fear in the market, and that is, what is generally regarded as the best gauge of fear in the stock market? Several choices on your screen. We'll tell you which is correct coming up.
Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a purpose-based retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
We hit you with a question of the day going into the break. It has to do with the fear index. Some people consider it that. The question was, what is generally regarded as the best gauge of fear in the stock market? And of course the answer is, Casey?
The answer is A, the VIX index and the volatility index of the market. And today we're going to be talking to Mike Sorrentino a little bit about why he says it being as low as it has been here recently is why it is a challenge facing investors moving forward. And Mike, I think most people will find that contrary to their typical belief.
Oh, yeah.
They say, well, volatility is low. That means, well, the market's going up. It's doing really well. Isn't it a good thing that volatility is low and market growth is high?
It is to a degree, and what I mean by that is that volatility acts like a compressed spring. Okay, so the further down it goes, and the longer it's down there, the more violent the reaction you see come back. Now, it's very important to understand that volatility does not derail $19, $20 trillion economies. It doesn't work like that. Volatility is not going to put us into a recession.
It scares the heck out of people.
And that's what it's going to do. It's going to cause people to lose sleep. They're going to get up the next morning, assuming they actually got a couple winks that night, call your team up, say, you know what, I can't take the pain anymore, get me out. Mm-hmm. That's what we can't have, because panic selling is one of the easiest ways to turn short-term pain into long-term misery, and we don't want that. And that's the danger behind volatility.
Yeah, and that's what we talk about. That's really what the purpose-based retirement is all about, is taking that anxiety out of retirees' portfolio. But the only way that's done, it's not going to be done by just throwing dollars into a 60-40 stock and bond portfolio and hoping that everything works out. It's going to be done by analyzing each one of the liabilities that you're going to face throughout your retirement years and knocking them out one by one. You know, when we put together a purpose-based retirement, it's liquidity for emergencies, income to last a lifetime, growth for inflation protection, and estate planning to take care of not just what's left over, but also protect what's left over due to potential long-term care needs. Mm-hmm. So we analyze each one of those liabilities and we put a plan in place for them. And that's the same thing you're talking about when we build an investment portfolio. Rather than just buying stocks and bonds, we're really looking at all the major liabilities we're going to face and not just buying and holding and hoping everything works out.
Look, buy and hold works great if you're 25 years old, and I think actually most younger Americans out there should just buy index funds and call it a day. But here's a fun fact for you. In 2008, most people don't remember, the S&P 500 actually fell below 50% at one point. That's 50%. Now, it took till March of 2013 to get back to the point where it actually fell off from. Okay, so that drawdown, that 50% drawdown, think about it, it's math. It takes about 100% to get back to where you were. Mm-hmm. Most retirees can't take that ride. Right. I mean, think about it. That was, what, 6 years almost? 6 years waiting to get back to even?
Well, that's not what retirement's all about, you know, and that was something I think my dad taught me from a very young age, you know, always going on appointments with him. He was a financial advisor for over 40 years, so I got to be exposed to a lot of retirees and pre-retirees over the years, and he's now stepping into retirement next year, and this is really something he follows in his own life. He says, why would I take unnecessary risks at this stage in the game? Make me 4 to 6%, don't blow me up, don't lose, and I'll be perfectly fine throughout my retirement years. Now, that becomes much more of a challenge today than it used to be, because interest rates used to be at such a high point. You know, even back in 2000, I can remember my dad buying a 10-year fixed annuity that paid him 7% for 10 years. You know, he was guaranteed 7% for 10 years, fixed rate. It was never going to go below that. It never went higher than that, but it was never going to go below that. Now, today, we don't have that same opportunity. You presented to us another major challenge facing investors is low interest rates. Yeah. And that is, I think, exactly what's illustrated here in this chart. So talk to us a little bit about low interest rates, where they're at today, and kind of what this chart all means.
Well, this chart is interesting because it definitely deals with low interest rates and the idea that interest rates are low right now and they're going to start rising. And that's the key component we're dealing with here. And most people don't realize that you can lose money in bonds. You can, and what we're showing here is this world today, this environment looks a lot like the 1950s. I know most of us weren't investing back then, but back in the 50s, owning a bond portfolio, I mean, I wasn't either. I mean, I was born in the 70s. So, I mean, that's just it. It's a foreign concept. And if you go back to that time period, look, we had the 10-year Treasury started at 2.3%. It doubled over that decade. And as you can see on the chart, it was a tough world to be a bond investor. Mm-hmm. It really was tricky. Now, that's not to say that bonds are going to be a bloodbath going forward because the Fed is raising interest rates. It's to say, look, you got to change your strategy. Mm-hmm. What worked for the last 3 decades in fixed income, that's done. It's over. You got to have a completely new strategy that is specifically designed to weather or actually perform well inside of a rising interest rate environment.
We can't just buy and hold those long-term corporate bond mutual funds, because I mean, we can see here long-term corporate bonds during that 10-year period lost what, 10%, 20% in long-term U.S. Treasuries. You know, if we continue to allocate our funds that way moving forward, we're going to be in a lot of trouble. One of the things that we can do is, if we have a large enough portfolio, we could be buying individual bonds and avoiding a lot of that interest rate risk, right? Or the price risk. Yeah. Alternatively, we could be using alternative fixed income assets, whether those are alternative investments in the securities world or fixed indexed annuities, where we can get that 3 to 6% over 7 to 10 years without the default risk and the interest rate risk. You know, there's a lot of things that we can do that the traditional financial advisor that got his start back in the 70s, 80s, or 90s, which is the average advisor today, just isn't doing. But we have to evolve in order to be successful in this next stage of the game.
No question about it. I mean, just think about the Barclays Aggregate Bond Index. If you want to have a passive strategy in the bond market right now, the ag is delivering, call it 2.2% income a year. That's right around where the yield is. It may be a little bit lower than that right now. So, I mean, ask yourself, I mean, with inflation currently right around there, the Fed's telling us inflation is just under 2%, which I ask the retirees that are currently listening to this program, whose medical bills are only going up 2% a year right now, whose grocery bills are only going up 2%, but this is what the Fed's telling us. If you're owning an index strategy, an index fund-based strategy, a passive strategy, you're not earning enough income to even cover inflation.
Right.
How is that going to work going forward?
Yeah. Well, I think another challenge facing a lot of retirees, you know, I know my grandparents, they would have never, you know, owned a stock or an individual bond or a mutual fund. They would have never taken risk, and they never did. And they were very successful, and they held on to a lot of cash. You know, a lot of the cash, a lot of what they had was in the house. It was, you know, under the mattress. I remember one time I opened up the wall to where they kept all their canned goods. And in the back, they had this old Maxwell Coffee House can that was full of cash. You know, that was where a lot of their dollars were. They were still successful, but they were slowly losing to inflation, a lot like people are today, with interest rates being as low as they are. If we're maintaining large cash balances, we are safely losing money. And there are things that we can do today, though, in order to get that cash working and not take risk and not necessarily tie up our money. However, the independent advisor is the one that's going to be able to show you that. It's not going to be your broker. It's not going to be your investment advisor. It's tied to a large firm that was founded on securities investments. It's going to be sitting down with an independent fiduciary financial advisor that can present to you all of the different options that are out there and find the right tool for the right job and get you between the point A and point B, which is a straight line.
Which is why I hope that you'll be taking advantage of our offer today, and that is for the next 10 callers who call the number on your screen right now, we're going to offer you a complimentary review of your entire retirement and financial plan, because the world has changed. That's the theme of today's program. What worked in the past isn't necessarily going to work so well in the future, and if you feel as though your investment plan is stuck in the past, here's an opportunity to sit down with Casey and the team and get your very own purpose-based retirement. So I hope you're one of the next 10 callers. And of course, if you'd like to learn more, you can always visit the Howard Bailey website at howardbailey.com. You can drop us an email at info@howardbailey.com, and we will see you next week.